Society Winnipeg, I'm pleased to introduce today's guest speaker, Johnathan Seeg. Johnathan is a managing director and the global head of client solutions and strategy for BlackRock private equity partners within BlackRock Alternative Investors. With over 20 years of private equity experience, Johnathan has primary responsibility for private equity partners, global strategy, business development, and client service model. Johnathan earned a Bachelor of Science degree in economics from the Walton School at the University of Pennsylvania. He also attended the Tech School of Business at Dartmouth College, where he completed the Advanced Management program. Johnathan is going to share how private equity is adapting amid major dislocations of the COVID-19 crisis. The topic includes valuations and lessons from past cycles, trends in secondary, and impacts on different industry sectors and opportunities. We'll also be running a live Q&A at the end of the webinar. Please feel free to send it through the Q&A feature, which is on the right-hand side of your screen. In addition, I would like to remind everyone to fill out the survey that will be sent after the webinar. With that, thank you for taking time out and being here today. So without any further ado, here's Johnathan, over to you.
Hello, everyone. Thank you so much for joining us. First, I'll ask, can you hear me okay? I'll do a sound check. Juliana, is it coming through?
Yes,
sounds great.
Perfect. Well, I also wanted to take the opportunity to say thank you to everyone for taking time out of your busy days. We know how much everyone has on their plates these days at home and in the office in these unique times we're living through. We wanted to take the next 20-30 minutes to take an opportunity to reflect on the private equity market. What are some of the trends that we see today? What are some of the opportunities and challenges? As was mentioned earlier, our team has been involved in the private equity market for the last couple of decades. And so what we've done is we've actually looked at all of the data that we have on valuations, volume, pricing, to try to see if we can find patterns from past cycles to understand and prepare ourselves for what we're living through today. We also want to try to address for you today some of the questions and comments specifically that you might have. So we also have reserved time at the end of the prepared remarks to go through a Q&A session. So please, we look forward to hearing your comments and questions as we go through. To lay out an agenda, let me advance here. We're going to go through 3 topics. First, looking back in time, what have we seen and what can we learn? Taking a look at the market today, and then also trying to get a sense of looking forward. So first, let's look back in time. As you can see, there's a lot of information on this chart, on these 2 charts, but let me explain what we're looking at here. So what you have at the top with the yellow bars is the return profile expressed in an annual rate of return, or an IRR, by various private equity vintages back through time. So this was the dispersion of returns and the returns that those managers generated for each of the various vintage years back in time. So funds that were started during each of these vintages. And the shaded areas were periods of economic disruption or recessions in the past. There's a couple of observations. The first is you'll see the pooled mean returns are in green, the green dot. And what's interesting is going back to 1999, and we can all think about the various economic backdrops that we've lived through over those past 20 plus years. The mean return, the average return for private equity funds was actually, has been positive in every single vintage year, which is interesting, which means the industry is actually fairly resilient. So even in the hardest years, the private equity returns were still positive. What you also can see is that the top quartile, which actually would be above the yellow bar, because the yellow bar represents from the 75th to the 25th quartile. you can see the top quartile has been generating returns anywhere from 10 to 30% net is the starting point for top quartile over time, again, through all the cycles. So that basically gives us some confidence, at least through multiple market cycles, that private equity has been a relatively attractive place to have capital. The other way to look at this is at the bottom, where we can compare private equity returns to public equity returns. And here what you have in the shading is actually a spread, or we're using the term alpha, of private equity over public equities, in this case over the MSCI World. And the solid line is the average spread, the average outperformance. The shaded line, again, is that 25th bottom quartile up to the top. So above the pink red shaded area would be the top quartile private equity performance spread versus the public markets. So a couple of interesting things here too, where you see that the spread has remained positive. It's been an average of about 300 to 500 basis points over time. But what's also interesting is in periods of distress, so you look back at coming off of the dot-com collapse in 01-02, you can see the 02, there's a little bit of a spike there, and then you look at 08, also a spike. So what this tells you is that going through periods of disruption, where you see more volatility in the public markets, you actually see you tend to see higher outperformance in the private equity markets. In other words, private investors are able to create more value. Now, that could be because they're buying at more attractive prices. There might be companies that are available for sale that aren't normally, but for whatever reason, you're actually able to create even additional return, more outperformance. That spread, interestingly, has been it's been compressing, I would say, the last decade or so. And I think that's as a result of, we've been in largely a bull market in the public equities. So it's been the volatility from that standpoint has been reduced. And you see that spread, kind of the average spread again, hovering around 300 to 500 basis points. So this is just a sense of, okay, if we're going through a period of crisis today, or if we have a recession looming on the horizon, as we go through a health crisis that therefore could catalyze a financial or economic crisis, perhaps what this indicates is that private equity should be a fairly resilient place to be and may have an opportunity to outperform. So that's sort of the conclusion from this. And that's why, if we just take a step back, I should have done this at the beginning, I think one of the reasons we're having this conversation today is that more and more investors are interested in understanding more about private equity. We're seeing allocations actually increase to private equity. In fact, they've almost doubled in certain client segments over the last, investor segments over the last 10 years. And certainly the size of the market is growing. So private equity in itself is going from something that's considered alternative to moving to something that's being considered more core as investors are increasing their allocation. So I think ever more the reason that folks are taking more interest. Here you can see impact on valuation. So there was a lot of discussion as the markets were getting roiled this spring with COVID rolling across, and certainly in New York, having the horrific scenes that we saw and the challenges that we're having. You saw the public market really come down in March. Of course, we know since then, for now, the public market pricing has come back. Stock prices have largely recovered. Interestingly, it's in certain sectors where you've seen significant outperformance. So we've had a lot of questions of, well, what's going to happen to private equity valuations? And so what you have here is in yellow, the private equity valuations as an index. So this is taking the industry mean. And we're rolling that forward from time zero back in '99, and we've rolled it forward to see how valuations have held up through cycles. Now, again, you have the shaded cycles there of periods of economic distress. And what you can see in the yellow is the movement of private valuations versus the public valuation movement of the stock market during that time. What's interesting is you do have a correlation, of course. You're investing in equities, whether they're illiquid private equities or public. There should be a correlation here. But what you do see is that private equity valuations tend to lag the public markets, first of all. I'll come back to that. But they also tend to move at about half or 50% of the adjustments. You can see, for example, in 08, during that time frame we have there, the shaded time period, you saw the stock market drop by 49% in that particular instance. The private markets during that time frame, 28%. So as you saw a drop in March of a number of the public indices, March 2020, some indices were down around 20% or so. The private marks, generally speaking, were down around, on average, 10 to 15%. So that actually held true, that relationship. What we expect to see going forward is, as June 30th marks are being reported by private equity firms, and there's a delay, we would expect June 30th marks to be back up largely to where we were in December, at last December year end. So the private valuations have generally were down about 10 to 15%. They've now come back up close to where they were in December. What is important is, as you're looking at various private equity managers, of course, it's extremely important to understand that each private equity firm out there can have their own valuation policy, as long as they are complying with a standard around marking to market. But some firms will lean into more public comps to value their assets, some will lean into private comps, some will use a discounted cash flow analysis, and all of the above. What that means is, anytime we're looking at unrealized valuations or valuations of unrealized, unsold companies in private equity funds, it goes without saying that we don't have an apples to apples comparison across funds. You can have different marks. Even when you have a group of private equity investors all in the same company, they could, in theory, have different marks for that equity. So one does have to be careful and cognizant of that when looking at private equity valuations. That's just a reminder on that. If we see a significant downdraft in the public markets coming forward here, you should expect that the public valuations need to be depressed for about 6 to 9 months in order for the private equity market to fully reset pricing expectations. So I'm going to say that again. There is about a 6 to 9 month lag for pricing to, I'll say, semi-permanently adjust down in the private markets. There is a lag of about 6 to 9 months to the public markets. If you see V-shaped movement and recovery in the public markets, the private market often doesn't have time to adjust that quickly relative to buyers and sellers negotiating pricing. A simple proxy you can think of is sort of the real estate market. If you think about the movement of the stock market and fluctuations, what people are paying for homes is not going, or properties is not going to adjust on a real-time basis either, right? You have to have a sustained change in an economic backdrop to then influence a sustained adjustment of pricing. So that's just something else to think about. As a lot of folks are talking about the secondary market, and we wanted to just touch on that, and we'll come into some trends we're seeing. I think there's a very interesting point here too to reflect on the secondary market. Here, what we're doing is comparing where we were during the last economic recession. So going back to the GFC, the global financial crisis in 08-09, and what was the market like 10 years ago versus where we are today? And the secondary market provides an example of just how dramatically the market, the private equity market, has evolved. So one of the things we can think about, and just we may have different levels of background on the private equity market. So when I talk about secondaries, I'm talking about an investor purchasing another investor's ownership or partnership interest in a private equity fund. And as a secondary buyer, I could buy out another investor's interest, potentially at a discount to NAV if they need to get out. So if we look back at the GFC, the secondary buyers are always feeding off of the funds that had been raised in the prior decade, because as we all know, private equity funds take time to mature. So if you look at the volume that a secondary buyer the universe of buying opportunities in the GFC is about 1.8 trillion of total capital that had been raised the prior 10 years in funds. Now that number is up at 3.4 trillion. So the market size has almost doubled in the last 10 years in terms of the depth of the market. The secondary transaction volume, this is pretty stunning. It's gone up by 4 times. So this tells you that the trading volume of secondaries is, I don't want to say it's becoming more liquid because it's obviously an illiquid market, but there is more volume. So there's more opportunity for price discovery, and there's the opportunity to trade, if you will, higher positions. So that's a fascinating structural evolution in the market. We also talk about GP-led transactions. This is where a private equity firm wants to work with secondary buyers to find a solution for their own fund. So a general partner who's managing a fund may actually decide to sell assets or finance assets in their fund using the secondary market. That market has exploded in the last 10 years. It's increased by 26 times. So what that tells you is there are more private equity general partners, or GPs, who are willing to use secondary investments, secondary buyers, to finance the extension of their funds, the restructuring of their funds, the refinancing of assets. That's another interesting angle. And finally, you can see the increase of credit facilities. So private equity firms and funds keep innovating in different features they can use, and credit facilities are being used increasingly for cash management and leverage, if it's more aggressive by some funds. This tells you that if we hit a period of economic turbulence, that use of credit facilities could bite folks, because if a firm has been using that credit facility to fund capital calls and has a large outstanding balance they want to draw down on from their investors, that large drawdown could suddenly catalyze a wave of sales, potentially. Or you could have funds that have structural issues. So that's going to be an interesting one to watch. In other words, there's a little more leverage in the system at the fund level. So these are just some reminders of the private equity market itself, in the backdrop of everything that's happening in the economy, is also evolving and innovating. So as we look at the market today, many investors are asking, so what opportunities are we seeing today as we go through the age of COVID, if you will? And more broadly, what is happening in the private equity market versus the public equity market? So there are a number of macro trends that are very important to pay attention to of what's happening with private equity. Again, I'll step back and say, we believe that private equity is actually going from alternative to core. And the reason for that is a number of factors that you see here. First, we have enough data now that gives us confidence that private equity has, on an enduring basis, has been able to generate significant outperformance over time. The challenge, of course, is illiquidity and having the tolerance for that, as well as manager selection, security selection, because you have a huge variance. You have the widest variance, in fact, dispersion of performance among managers. So there is obviously risk, but if you can solve for those risks, you have the opportunity for significant outperformance. That is becoming increasingly accepted as clients think about their liquidity versus returns and the trade-off. Interestingly, if you look at the size of the private equity market, it is still, even despite all of the growth, and the private equity market is growing by multiples over the last decade. If you look at the lower left, the private equity market, its size today is still a fraction of the public equity market. So as a percentage of equity, if you will, the private equity market is about 6.5% of the total equities market today. So that means that there should be room for growth. In other words, there are more listed companies that in fact could be private. There's room for the private financed market to expand. So we've had significant growth. it's still single-digit percentages of the overall equities market. So what's happening is you look in the middle here, the top middle chart is a fascinating one, I think, to look at, which is charting the percentage change in the number of listed companies, i.e. the stocks that we can buy, versus the number of private companies. And you can see that the number of listed companies in the United States, at least in this market, in the United States, has dropped by close to half since over the last 2 decades, let's call it. In this case, it's 96 to 2016. That's a dramatic shrinking of available securities. So we are seeing a trend of the public market security universe is shrinking. The private market opportunity set is growing. And one of the things that's happening is private companies are staying private for longer. So if I'm a CIO of a pension fund and I'm trying to look at where I can express equity theses, investment theses, especially in certain sectors like technology or healthcare, as we show on the right, what's happening is if these companies stay private for longer, a lot of that equity value creation, or more of the equity value creation, is shifting from the public owners to the private owners. If you think about the first wave of modern internet companies as we know them, Amazon, eBay, Yahoo, Google, many of them went public within about 3, 4, 5 years of being founded, 4 or 5 years. If we look today at some of the very large privately held companies, some of them are staying private for as long as a decade, some even more. So the average time that companies are staying private is increasing. So that's also causing us as investors to look at, as equity investors, what is my mix between private and public, and am I missing some of that equity value creation? These are some of the macro trends that are structurally happening in the equities market, if you will, both public and private. If we want to drill into the private marketplace today, the private equity marketplace, this is just a snapshot of investment activity, exit activity, fundraising. You would not be surprised to see that investment activity slowed in the spring, although it is coming back. Anytime you have a rapid movement or volatility in the public markets, you will have buyers and sellers that back away from each other. We talked about that price discovery and having a 6 to 9 month lag. So there was a window in the spring where deal flow came down, but what happened is interesting. We did see that there was a number of, I'll call it rescue financings of companies who did get into distress in certain sectors, particularly on the, I would say on the consumer side, consumer facing side, travel and leisure, where you had acute pain that's coming through those sectors. There is some distressed special situations rescue financing. We're also seeing some public companies who need to delever and they might sell off assets or carve-outs. And the other interesting thing we've seen is private companies, venture capital-backed companies who were preparing to IPO, but because of the volatility, they've put off their IPO and they raised another private equity round. So we saw more growth equity transactions occurring, especially with the attractiveness on the technology side. Exit activity, I'd say IPOs have been delayed. We're still seeing some evidence of some interesting IPOs. One of the IPOs, for example, that's being much talked about today, we have listed here with Ant Financial, which came out of Alibaba. It's a leading fintech company, financial services company coming out of China as one example. I think Snowflake, another tech company recently, you probably saw listed recently. So there are some interesting IPOs happening, but generally it's slowing. It doesn't mean that the exit activity will come to a grinding halt, but it will slow. That means that private equity investors are holding onto assets slightly longer. If you want to forecast on that, if your hold period is getting pushed out on some of these assets, what I would say is that probably means that some of the recent vintages of private equity investment, and it's hard to put an exact number on which vintages, but if we're holding on for longer, I would say that you might see average IRRs start to come down on some of the recent vintages of investment. And you may have very good companies, some decent companies, but if I'm making the same multiple of money, but I hold that company another year longer or 2 years longer, my internal rate of return will come down. So we saw that during the last crisis. If you see exit activity continue to stay low, then you will see those IRRs start to come down. And then you'll see some of the secondary firms also start to pick up. So that will be an interesting dynamic to watch. Fundraising has been fairly robust, but what we're seeing is a separation between the haves and the have-nots. Investors are, especially for all of us, we're on a Zoom call today. It's very difficult for me as an investor to do on-site operational forensic due diligence and walk the factory floor, so to speak, or walk the offices of a new manager or an emerging manager where I might be taking more risk. So what we're seeing is the market is tending to stick with names that they know, reinvest with groups that they know, stay with trusted brands. So in other words, you're seeing sort of a flight to quality right now, and that probably will lead to a increased barbelling between the haves and the have-nots on that. This is just a quick snapshot on pricing. Wow, look at what happened in the second quarter. This is a multiple of enterprise value to EBITDA, big spike in the second quarter. I think we have to be careful of that. We'll see if that's actually a blip or a trend. A few things. One, I think the volume was way down. So we have to look at the universe of the number of transactions that occurred to lead to that pricing average. There was also a shift into growth technology companies. So companies that could close on transactions or companies that would command a premium. These might be companies that are growing and still have low or minimal cash flow, and folks are investing based on future growth, which means the historical average is much higher. So it's a curious number up at 15 times. That is a big purchase price. It tells you that, as always, you need to be very cognizant of pricing, stay disciplined. But I think what I'm going to make a hypothesis, I obviously could very well be proven wrong on this, but it will be interesting to see if valuation stays up at that level as we roll forward. Most likely you'll see valuations come back down to where we've seen them. That said, if you look for the past several quarters going back into 2015, 2016, you can go all the way back to 2013 before you're below double digits on EBITDA purchase price multiples. So pricing has been full in the private markets, not unlike the public markets for the last several years. So time will tell if managers were successful in structuring and selecting the right companies. Certainly pricing reflected high ambitions for those investments. If we take a look at page 11, this is actually in deal volume. We're going to turn here into the US, and we're trying to drill in a little bit. So year-to-date volume, this is number of transactions that occurred, is down. Interestingly, year-to-date, volume is still above the years of 09 and 10, where we saw the last fall off. And those are full years. So year-to-date in 2020, we still expect 2020 to actually be a fairly robust year. It looks like it will come in. We'll have to see how the rest of the year goes, but it will come in above 09, 2010. We'll have to see if it surpasses 2011 or 12. So it will be down, but still not collapsing to the level that we saw in the last crisis. That's our anticipation. If you look inside the deal activity, again, technology, which I'll come back to in a moment, in the age of COVID has been an area that's attracted a lot of interest. So a significant portion of the volume recently has been in tech companies. If you look at some of the surveys of investor sentiment in private equity, it actually has remained fairly constructive. You saw in April, if you look at the green, folks who are saying, yep, I'm going to keep doing my thing, keep allocating. That did drop, obviously down around 30% or so. Where are we at? Yeah, you can see the drop there, right? And you can see that almost 22% put their investments on hold. Look at the red. Now we fast forward 90 days. My goodness, how times have changed. So folks are back to normal, at least when they're being asked to say, okay, the green has gone back up. People are saying, okay, I'm going to continue with my investing in private equity. And the folks who said they're putting things on hold dropped back down. So we'll have to see how the sentiment continues. I think what's interesting about this is when we saw the last cycle, for those of us that were involved in the private equity industry back then, you had what was called the denominator effect, which is the collapse in the public markets meant that if your private equity valuations were holding firm, your allocation to private equity as a percentage of NAV actually spiked and went up. So for pension funds who had a specific target allocation to private equity, they found themselves over allocated all of a sudden. So that caused a significant slowdown in investment activity and fundraising activity, and actually a wave of secondary sales. We haven't seen that yet. Now, one of the reasons we haven't seen it is that public stock prices came roaring back so quickly. So again, let's keep our eyes open on what happens going forward. But if we see a sustained, more sustained drop off in stock prices, public market prices, then I would expect that this color chart that you see here will move back to closer to something like April, where more investors are putting on the brakes and saying, I need to slow down. But for right now, people, the investor base seems to want to continue. Looking forward, and I'll be cognizant of my time here, and we'll also make sure we can go to Q&A. Where are we seeing opportunity? Well, first of all, lessons learned. Valuation. You can have the best company in the world, but if you pay too much, your returns will suffer. So we talked about valuations in the past quarter. Now is the time to be more disciplined than ever in the underwriting that investors have on private companies. Really thinking about what could be the impact on that business over the next 5 years, which is a typical hold period. What are the risks to execution? Watch your leverage. We saw in 06 and 07, too much leverage was put on these businesses. And if you end up selling that company for less later on, your equity is compressed. So, yes, interest rates are lower. Debt is fairly cheap. There are covenant-light loans available. However, if you really have to be careful about over leveraging a business. And we often look at, is a company actually paying off principal when they delever, or is it a company simply growing cash flow and, quote, growing into its capital structure? That's where you have to be careful. Geopolitical risk is rising around the globe. That not only impacts public equities, it impacts private equity as well. So these are the things, as a reminder to ourselves that we always need to be cognizant of. That said, there still is a number of interesting opportunities for private investors. This is where we've seen some interesting opportunities play out. Not surprisingly, technology. For those of us that are users of Amazon Prime, the Amazon delivery trucks and e-commerce delivery trucks are busier than ever. For folks who have children at school at home, who are working from home, we are honestly quite reliant for online shopping and delivery. So anything related to or derivative of e-commerce is growing, and Amazon and others like it are thriving from that. In addition, online content, online entertainment, gaming, mobile gaming, and with online content comes the need for storage. So storage, the cloud infrastructure, online payments, cybersecurity. These are all areas that are continuing to not only survive right now, but actually thrive. So you're seeing a lot of interest there. Healthcare, clearly. Telemedicine, we're seeing a structural change right now in telemedicine. But think about the likely rising tide of public investment in healthcare. So what that means for healthcare infrastructure, drug research, supply management, data management in the healthcare industry. In the black, you can see that also we would expect a number of distressed opportunities to give way, broken transactions that were trying to be done pre-COVID that are now being repriced, take private. So a number of ways that the private equity community is looking at finding attractive investments today. On the secondary side, another opportunistic strategy We mentioned some of these points before, but we would expect that you could see forced sellers come back into the market if we have more volatility. We have more investors that are looking at secondaries as being interesting on a risk-adjusted basis when you look through cycles. If you're buying a portfolio of diversified assets in the secondary market, you have an opportunity to have very interesting, perhaps risk-adjusted returns. You can protect your downside and still capture some upside. And the market is innovating, as we mentioned earlier. The last slide I'll leave us with is just, again, diving deeper into the secondary market in terms of the different pockets of activity. Right now, after we saw a cooling off of volumes in the spring, we are seeing sellers engaging again to sell portfolios. So now that the NAVs are back up on June 30th, if you wanted to sell something in the market from your private equity portfolio, a lot of folks are thinking now's not a bad time. So the volume we would expect to pick up. We expect discounts to widen given the buy-sell dynamics and the buyers being more selective. So valuation should become more interesting. We also expect more private equity fund managers, general partners, to use the secondary market to restructure, optimize, extend their funds. And finally, we would expect performance. In general, performance among managers will probably widen out, and that will also hold true for the secondary market itself. So those are some of the general observations. I'm going to go back to the title screen here. And with that, I will pause and perhaps we can take some questions.
Thank you, Jonathan, for walking us through that presentation. My name is Brendan Hargrave. I am the programming chair for CFA Society Winnipeg, and I'm going to be moderating the question and answer period here. So just a reminder, if you do have a question, use the group chat function and type it into there, and I will ask it on your behalf. We'll give a few moments for people to put some questions in there, but I think I will start it off with one for myself. Jonathan, the Fed's response to COVID-19 was faster, larger, and more broad-based than the Great Financial Crisis response. Can you maybe just touch on the impact that has had on the private equity market today, and maybe some differences there between going through the Great Financial Crisis and COVID-19 now?
Yeah, sure. So, well, a couple things. I think we talked about how the public stock price, the public stock market recovered quite quickly, at least initially. And so that actually, that quick recovery in the stock market meant that the private equity market didn't really have a chance to adjust, as you mentioned, on new transactions and pricing. So it means that right now, where we are today, that we would expect volumes to start picking up again, and investors we saw in the surveys are continuing. That lifeline that the government stepped in with has helped private companies of all sorts, both entrepreneur-backed and private-backed. So certainly they were the beneficiaries there in some cases. If and how those subsidies change or restart or don't restart, currently, that will obviously have an impact as well. I also think you need to look at sector by sector. So we're seeing more pain in the consumer retail sector, for example, travel. What's going to happen with those businesses? That's a very dire situation. And so those companies are going to need financing of certain kinds. So I think you're going to have more distress in some areas versus others. Technology, as you mentioned, is doing fine. So I think in the GFC, I think we saw more broad-based distress. The nature of what we're living through right now with folks, a number of people, living, working remotely, and those dynamics I talked about with technology has allowed some companies to actually thrive. So it's a very mixed bag, so to speak, in terms of looking versus the GFC. The final thing I would say is capital structures. When you look back at 06 and 07, the leverage was even higher than it is today. So suspect that, and the use of, there were covenant light loans, but I think they're even more pervasive today in certain transactions. So on average, you might see more companies who can actually survive for longer, given that maybe on average, more companies have reasonable leverage, although there is some high leverage, and can take advantage of covenant light loans. So we'll have to watch as to what happens in the default area, but the slope will probably look slightly different of defaults rates than the last cycle.
Okay, thanks. You talked a bit in the presentation about how companies are staying private longer than in the past. Maybe do you mind kind of just touching more on what is driving that? Is it increased reporting being public? Is it just increased scrutiny in general as being a public company, or maybe easier access to funds now for private companies? Maybe just touch a bit more on what are kind of some of the driving factors to that?
Yeah, sure, Brendan. You actually hit on a couple of really important factors. The first is, every action has a reaction, right? So as regulation has increased and scrutiny has increased, reporting requirements, et cetera, on public companies, some entrepreneurs are saying, well, if I'm running this company, maybe I'm not ready to go public yet, or maybe I don't want to go public yet. So, or maybe there's more preparation that has to be done to make sure that I'm ready to take on those obligations. And incidentally, the cost of regulation, so to speak, on a public company. So one is entrepreneurs saying, there's a greater cost to me going public than there used to be. The second is, as you pointed out, the ecosystem is evolving. So as the private equity market is expanding and the number of participants is expanding, you're getting a broader set of investors who can support companies staying private for longer. In other words, there are plenty of investors out there. You look at long-term funds, you can look at sovereign wealth funds. Certainly, as many folks on this call will know, the Canadian number of Canadian institutions who are saying, you know what, I'm willing to be a long-term investor with you, and I won't be a quote flipper of this company, and I will sustain companies who in theory could stay private forever. I'll put that in air quotes. So I think the ecosystem is supporting companies, allowing them to stay private. The last point I would say is that coming back to the secondary market as well, we've actually seen evidence of private companies who are refreshing their equity ownership base, their private equity ownership base every 4 or 5 years, so that those private equity investors can get liquidity and they can sell out in 5 years. And then the next wave of investors steps in for the next 5-year period. So there actually is evidence of some companies that are, and not every company can do this, but certain very defensive cash flow generative businesses have been able to sort of do equity refinancings, if you will, every few years and stay private that way as well.
It's an interesting change in dynamic for sure. We have a couple here from the audience. First one, how common are permanent capital structures and how do they differ from traditional funds?
Sure, so a permanent capital structure, there are more SPACs, blank check companies that have been issued that then they're IPOing, you can buy shares in them and they go off and buy target companies. There are a number of differences, obviously, in terms of governance rights, the security that you're buying. You have to understand risk profile. So I think it's hard to generalize, but you want to look at each. You'd want to compare an individual, if you will, SPAC to a private equity fund in terms of what is the portfolio construction, what is the investment strategy. Is the permanent vehicle structuring one asset or multiple assets? So I think you need to be aware of that. If you do invest via a listed entity into private equity, we also just have to be aware that we are buying a listed security, and that listed security will have more volatility in the way that it trades, could have more volatility, and the price of that security may be at a discount to the actual inherent net asset value. So sometimes they can trade at a discount. So just be aware of that. Doesn't mean that that's detrimental per se. If the underlying assets perform well, then you can have a nice return, but just be aware that you can sometimes have a disconnect on the price of the security you own versus the underlying assets. Those are a few observations, but certainly they provide the benefit of more liquidity as well. If you go into a private equity fund and you're going into a negotiated limited partnership, you are locked up contractually in that limited partnership until it is fully liquidated. So there's obviously a difference there as well. So I'd say valuations, pricing, liquidity, and then understand portfolio construction, diversification, level of risk that's being taken.
Thanks. Another one from the audience here. Who are the major investors in private equity in Canada? So maybe this looks like it's more on the structure of the Canadian market versus the US market. Who are the major players in Canada, and how have the rates of return compared to the US?
Wonderful question, and I have to say I'm sure there are others who are a much deeper expert on the nuances of the Canadian market as you look down through it. But I would say on the investor base, if I start there, the large Canadian plans have been leading investors out of the provinces in private equity. So we all know there's some very large long-term investors in private equity, very sophisticated, that are, I would say, in many ways more advanced in Canada, some of those large institutions than say some of the public pension funds that you see in the US. So there's some interesting dynamics there. So some of the sharpest and most innovative investors in private equity are in Canada at the large end. Interestingly, I think when you go underneath that on the investor base, I think the, if you will, the depth of participation or the universe of investors is probably thinner in Canada in terms of participation and average allocation to private equity by the entire universe of institutional investors. So from that standpoint, my observation is that the Canadian institutional investor base, when you go all the way down through mid-cap, small-cap institutions, is catching up to other parts of the world in terms of allocation to private equity. So that would imply, I believe, if we believe that there's a reversion to sort of a mean there, that you should see increasing allocations to private equity broadly from the institutional investor base and individual investor base in Canada. And I think we're starting to see that trend. In terms of the return profile of Canadian private equity funds, managers versus US managers, I don't have that information in front of me. I'd be happy to help follow up on that. I think I know there are a number of sharp, top performing funds out of Canada. So there have been some firms that have done very well. So I think you have the opportunity to achieve similar high quality returns, but I think the universe of available funds that you can invest in is smaller. So as always, you have to be careful. Be happy to dig into it further, but Canada is obviously has had a number of successful companies, and there's a number of successful private equity firms that have come out of it. So it's an interesting market.
With the increase in private equity activity and popularity among investors, have private equity fees seen any downward pressure? And where do you see fees going in the future?
Yeah, I do see, it's remarkable that it was, it seemed seemingly etched in stone that a private equity fund shall charge a 2% management fee and 20% carry with the rise of limited partnership agreements. So if you go back to the start of the institutionalization of the private equity asset class, right? So the ability of funds was catalyzed by the ERISA legislation that occurred around retirement plans and defined benefit plans, certainly in the United States. And when those first limited partnership agreements were put together, the pricing has held fairly firm at generally between 1.5% to 2% management fee and a 20% carry. That said, we would expect that you will have pressure on the fee structures. We're seeing innovation that's occurring where some managers have offered different options, a lower fee with a higher carry, higher fee with a lower carry. You're already seeing that even among some leading firms. We talked about the secondary market. You have the rise of the direct co-investment market, where investors are investing side by side or co-investing in the equity of companies, and co-investment funds have a lower, typically about half of what the fee structure is of a normal 2 and 20 fund. So you have some innovation that's occurring that certain institutional investors, when they look at private equity, they're realizing, you know what, I have different tools now that I can use to get my expense ratio down. Certainly, you also have the impact of technology over time. So we'll have to see, does technology play a role in creating more efficient price discovery and more perfect information, so to speak, on the pricing of assets? And then does that provide greater facilitation of fundraising for private companies? That would also give rise to more competition, would put more pressure on funds to in that competition to lower their fees. So I think overall, there's a number of trends around competitive dynamics, growth, structural innovation, transparency. These things should put pressure on fee structures. What will ultimately happen, even as you have that pressure, is that the top tier firms, the best of the best, will likely, as you have in any industry, those firms will still be able to command premium pricing because they'll show the net results that they've been able to achieve. And if they can sustain those, they can still be choosy as to who they want as investors. So the top tier, top decile funds really won't experience probably that much of price erosion, but the rest of the pack, you should expect to see more pressure over time. So time will tell. And also the whole concept of a locked up fund is also under attack. So client investors are seeking more liquidity options, which is going to influence the structure of funds.
I think we have a couple more minutes here. I see one more question. Do Canadian private equity firms have a presence or appetite for oil assets at the moment? I guess this is touching on the struggles in the oil industry, probably in the US as well. So maybe if you could touch on that industry a bit.
Sure. It's private equity funds, particularly in the Americas, have been active in the oil and gas industry for a long time. They have arbitraged elements of the energy stack. There's a lot of money that was made in pipelines at one point coming off the fracking, feeding new technologies on the E&P side. Some firms have been able to make some money on the services side. But for folks who are more familiar with the energy market, you know that there are different risk return characteristics depending on where you are in the energy stack, from services and E&P through midstream, pipeline, et cetera. So part of it depends on where you are in the energy industry vertical, if you will. There was a lot of carnage coming after from the collapse of the oil prices several years ago. There are private equity firms that were badly burned. They over-levered capital structures, particularly on exploration production companies or services companies where the revenues were whipsawed, or those companies didn't have hedging in place. So there's a lot of carnage that happened. Historically, when you've had a lot of people who are running for the doors, that's an interesting time for contrarians to be taking another look at consolidating certain parts of the market. So I think that private equity will play a role in the continued transformation of the energy market. That is for sure. How they do it is yet to be seen, but I think that the savviest energy private equity investors are patient. They represent patient capital. They can focus on take private transactions, for example. They can focus on consolidation, roll-up M&A strategies. So that's, private equity for many cycles has made money by arbitraging value off of the public prices and by consolidating markets. So I think there are some interesting themes to be played out, but time will tell. So I think that we have seen, if you want me to answer a little more succinctly, I would say allocations to energy private equity has certainly come down significantly. That doesn't necessarily mean that money can't be made and that the savviest investors aren't looking at ways to do that today. So stay tuned.
That's good. You definitely have to be patient in that industry sometimes. Looks like that's all for questions. On behalf of CFA Society Winnipeg and CFA Society Saskatchewan, we just want to thank you, Johnathan, for taking the time to have this discussion with us. I found it very interesting. And a big thank you to BlackRock for the continued partnership with both our societies. We really appreciate it.
Well, it's our true pleasure. Thank you so much for having us once again. Thank you.
Yeah, thank you. And thank you to all our members for joining us today. Reminder, there will be a survey that is sent out. We would really appreciate if you could take a few moments to fill that out. It would help us in future events. And we hope to see you again soon. Enjoy the rest of your day. Thank you.
Thank you.
Hi, everyone. I think it's just us. I'm pretty sure. Any feedback?
Well, it's John. Hopefully it went. It's hard when I'm talking for a while with a monologue. It's always, especially when I can't see faces, I couldn't really tell reactions. But I think that it was nice to see some of the questions at the end, which meant people were paying attention, which was good.
Yeah, I got some positive responses on the chat.
I thought it was a great presentation, and I think it was a good length and